annuity products have come in for some stick in the last few years, but the good old-fashioned retirement annuity is back in vogue. Following recent announcements from the Minister of Finance, annuity-type products are popular with financial advisors, but many would argue that these products are sold rather than bought. In this insert, we look at key questions to ask your financial advisor before signing on for a retirement annuity. Still in studio with me, Mark Ashton and Garth Tennyson, and we're joined by Craig Gradage, a director at GM Investments, and Jeffrey Wiseman. He's from Momentum Fiduciary Services. Welcome. Good to have you here. So, Mark, do you want to take this away? I get nervous when I talk about personal finance.
I get nervous when I have to sign things with my financial advisor, and I know because he's sitting 2 steps away from me. I think this is an interesting thing for us. Annuity products, one thing that irritates me the most is a financial advisor or product broker essentially arrives there, they roll out a laptop and they show you this graph with a fantastic payoff at the end, as long as you save your $100 a month or whatever it is in this annuity product. And then you actually trying to unpack what it is that you're buying. Is it life? Is it retirement? When does it fall away? What happens if you lose your job? And there are a lot of really interesting questions that we want to put toward financial advisors. So I think that was the thinking behind trying to put this together is what are you actually buying? What's important? What matters to people? And essentially give you something that's actually practical. Because I think often, and I know there's a lot of legislation coming in terms of how to change the way the products are bought and sold. But I think people do need to know what are they buying and explain this product to me, because I think it's too easy just to say sign here and essentially get your get a bit of commission on a broker product.
So, Craig, what are you buying? We're testing you now. If you can describe this in layman's speak.
Sure. Look, that's a very broad question, but essentially a retirement annuity product it's a kind of a portable pension fund or a very personal pension fund. So it falls squarely within the Pension Funds Act. And retirement annuity funds, it's contribution towards your retirement. While you're contributing, you get some kind of tax benefit from doing so. And from age 55, you can then retire out of your retirement annuity fund, take 1/3 as a lump sum out of the fund, and then the other 2/3 has to buy you a pension. So it really is a personal pension product, if I could describe it in that way.
So, Garth, I believe for this story you went and asked these gentlemen all the dumb questions, kicking the tires about this product.
I'm about to ask them a dumb question now, actually. Basically, what I want to know is who's the right person to take out a retirement annuity? Because I've always understood it as being something that's more appropriate for people who don't necessarily have formal employment or don't have employer contributions going into their retirement fund. And perhaps if you are self-employed and you maybe feel you lack the discipline to stop yourself from dipping into your pension if you ever run into hard times, maybe an RA is a good thing because you can only access it on retirement. So I was just wondering if you could tell us, if people out there listening, who's the right person to buy these products?
Well, Garth, I think everyone who is working, everybody wants to reach retirement at some point. And in order to retire, you need to build up a capital amount. And I think a retirement annuity is a product that can be used to assist with that objective or achieving that objective. So Craig has mentioned some of the tax benefits that are associated with retirement annuities, but so the employer pension fund is an important part. If you've got an employer pension fund, then you take that into consideration in deciding how far that is going to get you. But anybody else who's looking to retire, which is most of us, and looking to accumulate that capital amount at retirement, the retirement annuity is a very important part of supplementing that provision.
And if I wanted to supplement my existing pension fund that I've got with my employer, why should I choose an RA instead of just taking out an extra unit trust on the side? What's the benefit?
The main benefit is probably a tax benefit. So deductibility of contributions, tax-free growth on build-up. The downside is obviously you get the tax benefit now, but there are tax implications when you reach that retirement age. And I suppose the other thing that may be a disadvantage to some but may well work out to be an advantage in other circumstances is the restricted access before 55. So really as a product it really offers a lot to to support it.
I think one of the things we chatted about last week was psychology of saving. Essentially, South Africans, if you know you've got it, you're going to spend it. And I think that's been, for us, it was a very interesting debate to have last week was, how do you actually go and save? I mean, I know we were joking about the Exaro trade earlier, but every time I have a panicked phone call from my broker saying I need a little bit more margin, you've got to go and take in from your traditional savings product to go and fund your short-term whims. Are they used essentially as forced savings tools, Craig?
Yeah, I think I'll answer that question just to address what Garth asked just now. For us, retirement is about understanding that income comes from people at work or assets at work, and retirement is simply when people can't work anymore, then you need assets to start working. And a retirement annuity and your pension is one form of asset, and as Jeff said, they have certain restrictions with them. So when we sit with clients, we always make sure that we're not putting everything into retirement products only, because those restrictions can actually come back to bite you a few years down the line.
What restrictions?
Particularly the income restriction. You can only take up to 17.5% income as capital of your capital as income. So if you take 17.5%, at some point you will reach that 17.5% cap, and because your capital is dropping, your income will start dropping, and that's where you need investments outside of your retirement annuity and your pension fund. So I think it's a very important point that you look beyond just retirement products. Your question around the forced savings, it is a good protection for investors in that they can't access those savings, but also if a person becomes insolvent, or if they get liquidated, those assets are protected. So I think the forced savings element is important, but it's part of a whole broader issue of whether people are saving enough or managing their finances properly.
I think I was just going to jump in. I think one of the things that, as a 31-year-old, essentially one of my concerns is that I buy into a product and I have to contribute to it every month. And what happens? I lose my job, or maybe circumstances. Yeah. Those, I think, are one of the restrictional concerns a lot of people have when it comes to savings products of this nature.
Yeah, I think that's a very important point, because you now have what we call new generation retirement products, where in the past, if you stopped your retirement annuity payments, there'd be penalties applied, and there'd be clawbacks and all those funny things. With your new generation products, you can stop your contributions. The money that's invested remains invested, and there are no penalties for stopping. You can then pick up, once your finances normalize, you can then start contributing again without any further costs.
I do have one question. Either one of you can feel free to answer, but is it true that RAs by their nature invest in more sort of low-yielding, low-risk products because they have to one day provide an annuity income for people? And if you do opt for that, you then potentially miss out on some of the returns you could get in a bull market if you had a much bigger weighting in, say, an aggressive equity unit trust fund. Is that true or not true?
Well, all retirement funds have to be invested in line with the prudential investment guidelines that apply to retirement funds. So that is true to some extent, but in truth, one can still build up quite an attractive multi-asset portfolio within the prudential investment guidelines to give you an acceptable return over the investment period. I think if one does have a more speculative investment objective, maybe your investment in a unit trust is going to be the more suitable product for you, because you won't have those guidelines that will apply to that particular investment.
So does the potential investor, can you say, I want to see what the underlying assets are in this portfolio?
Yes.
And what's the performance like?
So you can select from a wide range of funds. It's just that the overall asset mix has to meet with the requirements of certain guidelines.
Can you give us an example of, say, how a balanced unit trust fund would compare with the average RA?
In fact, a balanced unit trust fund would probably be pretty compliant in the sense that it would generally be multi-asset classed. Normally, one looks with retirement funds, 75% is the maximum amount that can be invested in equities. So in your unit trust investment, you can go to 100% in equities. But a balanced unit trust, depending on what the mandate is, would have a mix of equity, bonds and cash, probably 60 or 70% in equity. So you'd probably be fairly safe with that in a retirement annuity in any event.
You can tell Garth's seriously considering buying one. Are you guys ready after the show to help him?
I've just heard so much bad anecdotal evidence that
Yes.
I'm trying to interrogate these guys to maybe change my mind.
And I think maybe one of the other questions that comes up, so it's a very simplistic question, but we often get told save 10% of your salary or save 15% of your salary and you should be fine for retirement. I mean, I think if you actually run the numbers, that's quite an interesting calculation to do. But, what is let's say 10% for picking a round number. I mean, what percentage of that should be going toward forced savings products, your RAs, and then the nice to haves, the unit trust that go around the outside? I mean, how do you break up something like that?
My suggestion would be to start with an objective. So I've got a retirement objective that is to accumulate a certain amount of capital that will provide me with an income during my retirement years. And then from that point to then look at what the options are. And there your employer fund would be an important contributor. You would then look at other opportunities, retirement annuities, if you are looking for tax opportunities or tax saving possibilities. And then one would look at other investments. I think it's a personal decision because depending on where you invest, you're taking on different levels of risk. And that is, it's a personal decision. The investor going into the product needs to weigh up where he's investing with the tax benefits that he's receiving from the products in order to build up something that is appropriate for him. And I think coming back to the financial advisor, I think that's where a good financial advisor can play a very important role.
Craig, is that your approach? How would you go about advising on how much should be put into an RA, for instance?
Yeah, it depends. Like Jeff said, how much you're contributing elsewhere at your employer's fund. And then once you've done the calculations, you don't want to put everything into an RA because of the restrictions. And also, you also need to take into account that potentially not all of your contributions will be tax deductible. So you'd be tying up money which you perhaps wouldn't really need to. But also given the fact that you have these restrictions, you do need to have some kind of discretionary assets to boost or to augment your retirement savings so that you have flexibility in retirement, that you can respond to life happening when you're in retirement.
We've got 1 minute left. I'm going to cheekily ask you, Jeffrey, if you could give me 3 positives of a retirement annuity, and Craig, if you can give me 3 negatives, those things to look out for. So starting with you, Jeffrey.
Tax deductibility, tax-free build-up in terms of the investment, disciplined saving to achieve that all-important retirement objective.
And Craig?
Negatives is potentially the conditions. So the restrictions around a retirement annuity. If you're young, Regulation 28 can be a negative. And then not a retirement annuity per se, but once you've crossed over to a living annuity, those restrictions on your income with income growth can become a problem.